Hi there, Alpha Team. Planty here again. Weekly preview for the 11th of March 2024. We'll start off with the usual risk warning that this is analysis rather than advice. Don't rely on anything that we say. And that brings up an important point of something that happened this week. Someone came flying into my chat, having a go at me without explaining at all what had gone on. And, I'm here, I'm open, I'll talk about anything. I'm giving analysis. If I'm right, 51.49, I've said before, it'd be great. I think so far the evidence is that I've had some interesting things for people to pick up on, and some people have made a lot of money this week by actually engaging with me. Please carry on doing that. And it was interesting that lots of people came flying in, not necessarily to my defense, but just for the whole process. And, we're here to try and go on a journey. If you're going to take up, anything that I've written and want to invest in it, surely you would check on anything else that I've written on the day over the last few weeks, or just come into me and check that you've totally understood what I'm saying. Now, I think we had the moral high ground if it was about gold, because we've been calling the nest for weeks. I just happened to be saying that maybe there was an opportunity of a little bit of consolidation. As it is, we said it's a little bit of a folly to try and create that. We're playing against the momentum. It's getting dragged up. It's very difficult to fade. We're going to try and pick levels. We want to buy it on a pullback if we can, but it feels very much like a close your eyes and carry on. But anyway, all of that will come out as we talk through the thing. So this week is Cheltenham Festival week in the UK, and that tends to have a big effect on people's engagement with the market. It's a big entertainment week for the city. Lots of people will be attending the event, certainly watching it, and risk in general in the markets tends to take a back burner. It's a quiet week data-wise. There's only a couple of major things to talk about. So it's very much, if we're going to have a consolidation, you'd expect it to potentially be this week, given the moves we've had. But again, we'll look at reasons why that may or may not be the case. So we could argue that to a certain extent, the market has been playing out a bit like a horse race the last few weeks. And what would that look like? So let's have a little go at the commentary. So they're under starters orders and they're off. And the markets are well priced at the start of the ACG macro challenge hurdle. And the field is travelling nicely. They've settled in to a steady pace. And 90s throwback has taken an early lead. They're picking up the pace down the back straight for the first time, but there seems to be trouble at the first hurdle, the post-pivot data. And we've had a few fallers. First cut in March is down and out of the race, with stronger dollar making its presence felt now at the business end. One more hike and no cuts at all have moved to the outside, and they're pressing 90s throwback, who still looks full of running as they pass in front of the February update sponsored main stand and head out into the country one last time. AI profits is surging through the field with bubble trouble in its slipstream, and rate cuts in June is now treading water as it slips back to the back of the field. Drew a pullback is prominent, and market breadth is yet to make a move. The next fence is a PCE update, and it's a monster as the horses tire. Cable tension and euros drifting have taken up the running, with Chinese bailouts looming large. Most have cleared it safely, but no cuts at all has clattered into that one, and he's back in the pack. One more rate hike, it's under the whip, and as we jump the ISM prices paid hurdle, he's been pulled up, looks like he might have gone lame there. The remaining runners have overcome some easier obstacles, with the data revision series making a few hurdles seem a lot lower than they previously were. Just a few left to jump now as we round the bottom of the hill. Most still travelling nicely. Yen carry no more and dollars too high have struck for the front, but the Japanese rider seems reluctant to push the mount on. Dollars too high now being ridden along and looks to have run its race. As we approach the last two fences, US CPI and the last sprint PPI, we have market breadth and Dewar pullback fighting it out. It's market breadth from Dewar pullback. Market breadth just in front. But growth trumps everything, and golden nesting look to have a double handful of reins here. They're coming through if they've got clear ground. So who's going to win that one? Look out for the data this week. US CPI and PPI. So last week, we've probably had what you could consider to be a fantastic week of data. As we said, we've been talking about, was January for real? Would the revisions come in? Would it look like there were aberrations, seasonal factors? Services was a seasonal factor we were looking to pull back across the board. Pretty much that happened. What's going to happen now? We've had a lot of breakouts, so we're going to have consolidation. I certainly wouldn't say short most of these markets. They do, to me, look like we're in a bullish phase. I'll chat about what the bears are thinking in a minute, but quite a few sensible ones are getting close to throwing the towel in, and quite rightly. It's been difficult. You've been squeezed to high heaven if you've been a short for anything more than a few weeks, and even in that case, the last 5 trading days have been monumental. So, the major criticism from the bears for the US market has been that this has been tightly driven by the Magnificent Seven, no breadth at all. Well, I'm sorry, guys, but you've just had some of the equal weight indices go to all-time highs this week. You're looking for breadth. It's there. Why are you not talking about that? You should be saying that perhaps your narrative is wrong. I'm very willing to change if the data changes and go, this is all these 3, 4s and 5s of the nests have folded in and it's time for a decent pullback. But it certainly doesn't feel like that, and the charts don't. Some clever people have been read the chart that's in front of you. Don't try and extrapolate too much. I think it's really good advice. So higher highs in general, that should count, shouldn't it? And what I'm going to do is, when we come on to this week, we're going to just review a lot of the things that we put out as our tweets, because I think they're quite instructive and they include all the data. But what does this week actually look like? We've got US CPI on Tuesday, which is Champion Hurdle Day at Cheltenham. We've also got UK wages and unemployment. Probably the only thing that matters there is how much the punchers have got left in their pockets. US PPI will be the end of the week, and that's the one that really had the PCE push-outs on hospital costs. Not sure if that's a one-off. And the market-related commissions, etc. Well, the market's pushed on since, so there's every chance that comes in quite hot again. So every chance we try and push ahead early in the week. Little bit of nervousness around those 2 inflation prints, and then that'll be a full house, as we've been talking about, of all the data. If they come in, sanguine, we're looking for rents, really. CPI is a very strange index relative to the rest of them. It's the reason the Fed don't use it. It's too heavy in rents, and although it's reflecting in short-term prices, there seems to be too much weight in things that shouldn't matter that much. I mentioned last week about TV clues with the weakest link and the Nationwide Virgin tie-up. Did we have anything at the weekend? Well, Arsenal were looking tired and looked like they'd blown their title chances, but they consolidated and then pushed on for a late winner. Is that a sign of what the market's doing? Liverpool and Man City played out a draw. No one really willing to take up the reins of the title race. So, in a consolidation pattern. England, absolutely bashing it out of the park against Ireland, the premier team in Europe. The trend was with them, but they were twice behind before they surged to front. That's a classic 5-wave move, isn't it? With a breakout at the end. And then, to me, the Cassandra for the week, the one that might be telling us why we have to take a back step, is Oliver Bearman. Came out of nowhere, the teenage prodigy for Formula One, just made his debut, and he's scored points on his first appearance behind the wheel. Fantastic, Can we ignore that? Maybe that is the sign that this week is consolidation. What we did miss last week, but we've drawn into this week, is British Pie Week. And I do love a pie, classic northern lad. We've got a few of those at Alpha. So, we set up, I thought it'd be much better to look at the pies for the week alongside the racing. So, rather than hopefully we don't get a custard pie in the face, or we don't overindulge and do a desperate Dan cow pie, literally eating a whole cow and not being able to keep the market up. So I'm thinking we'll start off gently, something light, a Melton Mowbray pie with a bit of chutney, a little Loire Franc red. That'd be a rather sophisticated way to get the week off to a start. It's a boring Monday. And then Tuesday, the racing starts in earnest. And we don't want any indigestion coming from the CPI around lunchtime. It's an hour earlier this week because of the springing forward by the US. So again, we'll take it easy, something light, a fish pie, a Rick Stein fish pie with a little Spanish carver, perhaps, just to put a bit of fizz into things. Wednesday is a classic day at Cheltenham, and you've got the Queen Mother's Chase, which is basically a 2-mile sprint over fences. if I didn't mention earlier, Cheltenham is premium, top quality racing, which is done over jumps, either hurdles or fences. Absolutely wonderful thing to behold. And if you get a chance to go, you really should. Lots of city people go, but it's a real good crack, as the Irish say. They play a big part in it. So with that, we want something pretty game, and I've gone for Alex's favourite, which is Wild Beaver Pie. That's a classic stale and ale jobby, and you need a stout ale there or a strong bitter. So we'll go for Old Wallop. And then Thursday this week is the Irish. It's the Irish Day, St. Patrick's Day. So the racing goes by the wayside. And if you've ever been to Cheltenham on that day, you have a choice for each race. You either watch it, you go to a toilet, or you go to a bar. Trying to do all three is nigh on impossible. And the best thing to do is down as much Guinness as you can and remind those lovely Irish fellas just how wonderful England were on Saturday and how we're back. And I'm sure they'll love to hear every minute of that. So you've got absolutely smashed on Thursday. You've got one more day to go, Gold Cup Day, the pièce de résistance, hopefully breakout day again for the markets, but we need to sober up. So let's start the day off with the full English breakfast pie, everything in there, absolute calorie fest. But we need something to cut through that. And as the French know, if you've got a hangover, let's crack out the champagne, add a bit of English twist in there, and we're going for Bucks Fizz. All I can say to that is, am I making your mind up? An old one for the oldies there. So last week, remember it started off with OPEC trying to meddle with the oil market. Not had a great deal of impact yet, but we are moving up, and I think the chart will show later that $83 is still in play. In general, all the data continue to come in well. You know, play every chart, every ball on its merits at the moment, because we have had some fantastic moves up. It would be ideal to consolidate these moves, just to, give the bears a little bit of scope, but also everybody just to calm down, retrace and bed down, ready to go again. A lot of the charts could easily have a 1% to 2% pullback just to fill in some, classic pullback waves, and then we go again. And we'll look at that in a short while. What else have we got? So yeah, 16 out of 18 weeks last week spoiled the party, but that hasn't happened since 1971. That was the Yorkshire year of the plant. You know what I mean? Outside that, we've been talking about gold breaking out, and it has done. What's been left behind? The gold miners. Now, some people have been doing that technical mean reversion trade of buying commodities and selling the tech outperformers. That can only continue, I think, in the short term. I mentioned that Clarkson might be interesting. The British shipper, global rescue ships and transportation. They have had record profits, but no real comments about Red Sea issues. China, pretty underwhelming from all the speeches, 5% growth rate, not a lot different from this year, and they missed that. I think the most interesting thing was how they've muzzled Premier Li Qiang, who, because of predecessors undermining Xi Jinping's effectiveness and the comedy moments, he pulled the rug. He wants to do all the jokes. Apple and a number of other things, AMD, started to show slight cracks, a little bit of consolidation in the tech indices over the week. The situation for Apple had the Europeans hitting them with a fine. They also had the 6-week early Chinese mobile data coming in, and that was down 24%. Apple slipped to fourth, a lot of it down to localized trends of purchasing. This is early signs of nationalism from China. They've done it with EV cars and not buying Teslas, et cetera, et cetera. You've got Trump on the other side of things saying what he's going to do. It's slightly dangerous for the whole the geopolitical thing and the world trade, globalization trade. We'll keep an eye on it as the year progresses. But, there's some early signs that people are playing things that way. So Super Politics Tuesday with the nightmare scenario of being left with Biden and Trump that nobody wants, and Haley's now dropped out of the race, couldn't get the funding, couldn't quite win enough. But outside that, PMIs across the globe are generally strong. We put out a chart showing you that. Only really China, India, and the UK were just giving up a little bit of ground. Could the US show the same trend? But they ended up staying with the slightly down guys, which is what we're looking for, a little bit of unwind of all of that. Services particularly strength from the previous month, because services, I remind you again, is the biggest part of the economy. Bostic couldn't help, put out a little negative. He was saying that he started the year with 2 rate cuts in mind. That's still got a chance. He wouldn't even move away from the probability of that only being 1, but he was definitely talking about 1 month and a pause, which is what we said from Jefferson the other week, following the 1990s playbook. So CME tool is still suggesting 66 to 70% chance of a rate cut in June, which also includes a 50 basis point one. But in general, the data is going our way. We put out the Jean-Luc Picard and data picture, just because the prices paid element of ISM really did go through the floor, and the employment side of things was suggesting what might happen on Friday for non-farm payrolls. So this is how we build up pictures. I talked to you, it's not all about seeing the headlines, it's where the consensus is. Consensus could be down, but the number could miss to the upside, could beat to the upside, and you get a complete opposite effect. And a lot of these numbers get revised. We were looking out for that on Friday, and that did work out perfectly for some people. The budget was pretty much a nothing done in the UK, other than the fact that he didn't mess it up. Rate cuts are still on the agenda. The main thing coming out of that was it looked very much like a party political broadcast. They were taking on Labour in its tricky issues, and also in the tricky seats, throwing rescue, levelling up money a little bit too late. We've had a lot of shenanigans going on in Bitcoin, gold possibly being dragged along as another alternative dollar replacement, but it did make its highs despite good old Jimbo on CNBC saying that it wouldn't happen. So he once again looking rather silly. Starting to see some signs of contra investing back into China. This is good. Is this early signs of that emerging market flows we were talking about, rolling out, causing that dollar weakness into Q2? It's all playing out nicely. A little bit of M&A action started to come into the UK this week. Spirent, one of the few decent tech names left. That's been bid for, 60% ahead of its close the previous day, a $1 billion takeout. We've since had Mondi looking at the paper and packaging UK giant that has a big contract with Amazon, David S. Smith, and Nationwide have approached Virgin Money. Outside that, Greg's, the high street and breakfast lunch favourite, had whopping results, mainly due to late night opening and sharing store franchises. They're increasing. And as I said, who doesn't who doesn't want a midnight sausage? In the States, US Target top estimates online was slowing slower than previously reported. So that was taken quite well. Something interesting from the sidelines, I don't know if you were around in the great financial crash in 2007-8, but Dr. Doom himself, number one, Doom the first, was Nouriel Roubini, and he happens to be coming out on the side of growth is wonderful. Pretty much like I've been saying, the growth is there. He's not even worried about the rate cut. So, when some of the super bears are turning that kind of way, expect further breakout. Where the narrative might change is it might become more fiscal policy than monetary policy now. And, governments, particularly the US, need to have a handle on the spending. We've seen the government shutdown shenanigans, and that's only going to carry on getting pushed back by the look of it. So outside that, we're starting to see a little bit of consolidation in the NASDAQ, Tesla, Apple, Alphabet, all retracing a little bit. Lots of China nationalism around. Is it a combination of both or a healthy mix? I think we'll lean towards the latter. Wednesday 6th, went into it looking for Chris Kamara to give us the rundown, really, because everyone was bored to death with the way the coverage was for Super Tuesday. It was a nothing done. Nothing we didn't know, nothing we wanted. Trump and Biden, part 2. We said the budget came through, that was dull. Germany showing signs of uplift, and the dollar really starting to break down on Wednesday. So that was good. Gold had its 6th day of a winning streak. That carried on throughout the week. Lots of things for you to read about. I've mentioned them before for the budget. ADP going into Friday, that showed a weakness, which suggested the direction may be going our way, certainly down. The Beige Book mentioned that. That is basically a school report for business in the States. And the best review I saw of that was the fact that if you read that on its own and didn't know anything else that had happened, you'd expect rates to have been cut by 100 to 150 basis points by now. It's really showing you that things are bobbing along, but they're not going banzai, and the prices being paid are under control. So what are we waiting for, really? Bank of Canada didn't make any changes to their rates, but they did change the commentary to slightly more dovish, and their productivity, mirroring the States, start to come in ahead. So again, that makes a little bit of ballast for inflation in the system. Powell on his first day, pretty boring, well rehearsed, read the report. And as you'd expect from these things, I tried to explain it during the week. It's like when business people go in front of the Treasury Select Committee in the UK. It's embarrassing. All these politicians, in the main, it's amateur night versus professionals, and they find it very difficult to score any points. Bit of a nothing done, really. Jolts, the job opportunities, that had a nice revision down. So we've made the read through again, another bit of data that might see at non-farm payrolls behave or certainly get revised down. And the quits rate has started to normalise. Just as a jolt to the memory, the quits rate was high and worrisome because people were quitting quickly to take up lots of job opportunities with higher salaries. So if that quit rate is slowing down, that sounds like wages are normalising. That's good for inflation. So, as I said, no really major fumbles from any of the secondary players. EIA oil data, that came in and backed up API. So the two prints on oil inventories this week showed that they were going down, which means that the refineries must be back on track. And I think that came through. One of the numbers is refinery related, and that was certainly taking its inventories down. So again, that should help ease the tensions in the oil price. The OPEC, not only have they, made a cut to supply, they've artificially bumped up the prices. They'll get this little blip up to 80, but it shouldn't have much momentum to follow it through. Cash and Carry was back. He was saying 2 cuts in December, but so far he's saying that's a max and 1 again. So it's 2 of them saying it's 2 and 1. Daly, I said, would have to appear at some point. She wasn't slated to, but she appeared and started talking about a broken housing market was causing inflation, and the interest rates are obviously adding to that, but would only be a temporary effect. Japan, everything we've been talking about started to come together. The back and forth between Ueda and his officials seemed to go by the wayside. He said that whatever happens, they'd continue to put money into buying JGBs, so the overseas owners shouldn't have to worry there. Overtime pay and wages start to come in high, backing up what's been going on with the CPI in Tokyo. So this is wages following prices. The finance minister said that we should avoid market volatility, but let the market decide. Nagakawa said, basically, we're not far off on the negotiations. We have to wait till the end. And then some of the unions started revealing where they were. And the biggest one, Rengo, is asking for 5.85 against 4.9% increase last year. There is another one, Zent, and they're asking for 6.7. So this all fits. The market's got very excited. Mitsubishi have said that they've placed themselves for an early rate cut. They're looking for March as a decent chance. The swaps market put 70% in. So we finally did get a breakdown of UJ this week. Hit 148 and then it went to 146 and it's somewhere in between now. 140 is probably the target we've got for that around the rate cuts. We know they're only going to do it in small steps, but we've got this dollar weakness in the background. Combination of those two should get us to 140, and we'll see how we react from there. Halifax price index didn't back up the nationwide. China trade data looked encouraging because the total trade surplus for the 2-month holiday period is at its record of 125 billion US dollars, but that was all down to exports. Tech's in vogue. They're a big tech exporter. Imports were down. Shows you that their domestic demand is poor and not looking like improving in the near term. I mentioned that Nationwide had made a play for Virgin Money. That's not something that you would do if you thought that the housing market or a recession was coming, or a blow up, anything that was going to blow up, loan defaults. You'd be looking to bunker down, not necessarily make a massive play to become second in the industry. So that is an encouraging sign. They actually waited for the day after the budget. So again, that shows you that the budget was decent, and the David S. Smith bid came the day after. So, UK PLC discounted, up for sale, probably. Can you nick some cheap bargains? I think that trend will continue. And in the States, former Treasury Secretary Steve Mnuchin put together a rescue package with a few other similar hedge fund and capital partner type groups, hedge fund capital money, to bail out NYCB. They put $1 billion in. We'd said previous week they had this $37 billion exposure to local government related rental agreements. This should hopefully be a good signal to the market that things are fine. Powell backed it up in his Thursday comments with, we're very happy with where the risks are in commercial real estate and banking. There will be some casualties, but nobody significant, nobody large scale. We had the ECB meeting. Nothing done. We didn't expect it to be, but they're really moving ahead at a quick rate of knots here on the data front and the likelihood of being the first to cut rates in June. They want it to be June, but they have said that the inflation outlook is moving at a pace. Previously 2.7 for 24, and that's down to 2.3. 25 and 26 are basically at target. Some people are looking at the 3 and 6 month rates. We've talked about that before, and they are basically at 2%. So if the wage elements come in, it's the last shoe to drop for the ECB, the last thing they're looking at. That trend needs to come down, and they'll go in June for sure. She's tried to say that they are independent. Someone challenged them saying there's no way you're going before the US. She was adamant that they're an independent, large-scale, important player in the world, and they'll do what they want to do. So again, Powell, as we said in the racing commentary, no rate cuts has fallen by the wayside. He's come out and said, no, data's getting there, and we will be cutting rates this year. So that should push back on a little bit of the narrative this week. We've managed to rail back the data, which was saying that we couldn't have the rate cuts, and some people were saying there'd be no rate cuts at all. Very much looks like we're back to where we started. The market's back on 3 rate cuts. The Fed pivot is for 3 rate cuts. Everyone's in line for the minute. What can go wrong? CPI and PPI. Boom. Friday, weak household spending in Japan, but that was down to Daihatsu, a subsidiary of Toyota, having some certification problems. So the big heavy item of car buying didn't come through the numbers. That's supposed to be temporary, so it was ignored by the market. German industrial production came in positive. I said there's some good signs for Germany, and the DAX is having that combination of industrial rebound and tech breakout, so that's in a lovely spot at the moment. Non-farm payrolls, we had set it up nicely. We came to a conclusion going in that that number could possibly beat. It was a big pullback in the first instance to come from 353 to 200, but that 353 was probably at risk because all the other data was suggesting revisions. We got a big revision, actually 167 over the combination of the December and January numbers, but I think it was 124 for the actual January data. Key to the whole thing was the wage component actually missing to a downside, so absolute double whammy. A net non-farm payrolls in control. The unemployment rate went up just to create a few worries for the Fed that they might be overdoing it. There's a few technicals why that happened, but it's all the same. We'll take it. It suits our bullish case. Private payrolls were more or less in line. Hours work didn't change. So, a fantastic end to the week, and we did get an early move up to record highs. We had a pullback then. Is that profit taking? We keep saying, there's at any moment, any of these threes are in a valid position to just fold and put in consolidations and final tops and see that cascading movement. At some point, one of the threes has got to do that. And, it'd be healthy if we did have a little pullback this week before we then push on into Q2. I've looked at Chinese CPI yesterday. That came in positive and above forecast, and their input prices, PPI, were negative. So not sure if I want that to repeat, but if we can see something similar in the US where you can explain it's still down to rents, which everyone is saying is an anomaly, and PPI reverses some of its positivity from last month from the PCE components, then that will be a net win for this week. Last week, the talking heads weren't so prevalent, not very much at all until Powell had his go, but all that came from that was rate cuts still on, systemic risks muted. We talked about Daily, we talked about Nagakawa. Mester reiterated we will have cuts this year, but we're going to wait. And then John Williams, actually I haven't read what John Williams said. I'll have a look at that another time. So without further ado, we will just have a quick look at some charts. So I've got the dollar index. We talked about hopefully this 104 spot 9 number that we had, 104 spot 967 is the 2 wave of this 5 wave consolidation down to finish an overall consolidation wave before we move on to new highs for the dollar later in the year. But within that, it very much looks like we're doing nesting 1-2s. We started to get really impulsive as this week went on. We took out a good order zone there. Head and shoulders wise, we effectively broke that at the end of the week. I'm not quite sure whether that's still in play, but it certainly is a trend line to follow. Looks like we've got one more little bit of downside to put in early this week before consolidation rally. That might sit with the indices and gold maybe having a little consolidation before we resume later in the week. Again, that all marries up with CPI and PPI behaving and is very much looks like a playbook for the week. Gold, we called the nest beautifully, really, and it's looking like we may be putting in. I think we put a third wave in really around the data on Friday. They went to a new high, which potentially is the 5 sub-minuet, micro-minuet moves here that's put in finally a whole 5 waves for a sub-minuet 1 there. We had within all those hourly moves on Friday, it's very likely that we've put in a 3-wave consolidation to put in the 2 there. We're going to be tracing out another 5 waves to top out this whole move here to put in a final 5th wave. So this could easily do within in and around. That's why I'm slightly cautious this week. This could easily do a double correction, which takes us down to the sort of 2160 level. But again, it all depends where we're topping out on this. So already, that's the top for the move so far. Spot 618 gets us around 2167. There's this kind of feel that the moves are going to be shallower than you'd normally expect for 1s and 2s. So it's quite likely that could already be in place. We don't actually get a chance to get in yet again. But I'd expect maybe a retest of what that current 2 low is in a lower degree 1-2 test before it breaks up. But we should get 2000 plus at some point this week. And then we carry on with the relative nesting to even further new highs. And as you can see, that nesting, we've been following this lower pattern. We've been following this lower pattern down here, breaking out this nest breakout of last week. Just to confirm for you here, the consolidations, we're going to get up to 22, anyway, 22, 25, maybe all the way up to this next fib, 2250 level, 2.31. We're going to have retracements. It goes again, retracement goes again. But all eking out high highs. 2350 is very much has been a target for this major 3rd wave, and then that again should consolidate. Ultimately, what we're looking at 2500 before we get any kind of serious pullback. This is why once a wave of that size is in, a 38% pullback relative to the starting point will probably get us back to around where we are now. But what it does, it creates a new base. and puts a lot more confidence into that commodity and drags other people in because of its performance. So it's sort of self-fulfilling prophecy. So with oil, look, the bigger picture on the cycle basis, it had a one top here back in 22. We're looking for consolidation, a three-wave move, which is subdividing quite a lot into a WXY. We're currently in a connector of the Y leg, which is a B wave. And within that, there's a WXY, which has been playing out, which we think the 1-for-1 of W and Y equals 83. Nothing's really changed in that, but we will go and have a look at the lower time frame. So here we are, the hourly time frame. We've got that consolidation momentum downtrending situ. It very much looks like we're bottoming out here. Tiny little bit more move for equal legs of this current move down to around 77.30, and then we should have a final move up, which is probably a C leg, which should be a 5-wave move to the upside to create this Y leg, which finishes B, and then all the negative fundamentals should come crashing back into the crude oil price. As the Germans, they are doing absolutely fantastic work. If you remember when we were back in NVIDIA territory, we expected it to consolidate and hopefully hold the channel, which it did. And then we said we were looking for the third wave that was beginning from that channel support to be a 1-spot 618 move. And look, we're just shy of that right now as we're consolidating. Could easily interpret this pattern as requiring one more high to finish. And that could easily be at the 1-spot 618 today or tomorrow morning. CPI angst perhaps gets a pullback. I'd love to see another consolidation confirm this channel, and then it's breakout upside again. You know, the DAX, everything is coming together for it. Keep mentioning it. It's a bit like the Scottish rugby team. People didn't give it the credit over the last 5 years that it had for recovery, and similar things happening with the England rugby team. You know, Germany, early signs of recovery. China may be throwing some money around soon, which helps with the imports and Chinese and German exports. Tech's looking good. ECB cutting first. You know, what's not to like about Germany perhaps leading us into the second quarter. I mentioned GU, EU, AU last week as all being major beneficiaries of this dollar play if it were to accelerate an impulse to the downside. We've certainly had that. EU in particular, quite strong. It's put in 4 of the 5 waves since the start of last week. Been a real powerful rally up. So this could easily go and put in a little 110 print and then a 3-wave back. This looks like a solid support block. And then we'll break away again, just like when we see the dollar acceleration return after it puts in a little consolidation. It's almost in the mirror image. And I expect all 3 of those U pairs to react similarly, but this one certainly looks pretty well held at 109, 109.20. Look out for any pullback opportunity, but it may well just be worth getting involved right from here. There we have the SPX equal weight index. You can see it's put in a new all-time high and also an all-time closing high on Friday. You know, what's not to like about that? Looks like it's consolidating, may well have already done enough, and we're now embarking on new highs. You know, the next stage of momentum could really see a lot of bears crying into their soup, towels going in, you name it, the works. Because, you know, this is just looking more and more impulsive. So yeah, here we have the normal weighted S&P 500. Again, we've been hugging the lower trend line of the trend line we've been following, but within that, there's a chance to tweak it a little bit, tighten it up. And, you know, I can see the arguments that are being made that there's potential for there to be an ending diagonals, a little potential bit of overlapping of some waves in here, but in any case, if that is deemed to be the top on Friday, then, you know, a 38% pullback and into what looks like some quite strong support zones in here, then that seems to marry up nicely for a shallow pullback, and it's off to the races for even more impulse, just like the equal weight is showing. Don't know why people are wanting to fight this, because it's not really showing any signs really of blowing up. I mean, you could argue, there's a lot of volume on Friday, but a lot of that was to take it to the all-time high and then the consolidation. I don't think it's necessarily a turnaround, but I'm quite happy if we see some consolidation. It would make the patterns, sit a lot better and encourage more upside. So bring it on, really. And if anything, just to get some false selling into the market that we can whip to the upside. So as I said at the start of the preview, there are quite a few people who had a bearish setup starting to talk about unwinding it, and yet you've got some who are still there. They've been shorting it. They're almost 100% wrong for the move. Been going on for over a year. They've been looking for, they've called the top 20 times, and eventually they'll be right. And it's quite a dangerous thing in investing, that if it's all well and good timing 10% pullbacks and being out of the market, but you've got to get back in as well, because in general, the market's impulse forward. It's a growing engine. You got 100 to 300% moves up, and you're trying to time it for a couple of 10% pullbacks. Net, you're going to lose money if you don't time properly. It's so difficult to time those in and outs perfectly. So you can see why some people just want to be long and manage around that. But we're here trading, so we're happy to see those pullbacks and be playing both ways. But when we're talking about the weight of money and when it suddenly runs us over, we need to be aware just when some of these calls are just plainly wrong, and that the impulse is the opposite way. So that is why FOMO and MOMO become so popular, because that there's much more upside that you're missing out on, unless if you get a proper crash, then you're going to have the 25, 33% pullbacks, and you need to be aware of it. But calling that every week isn't doing anybody any favors. Just a quick reminder again, next week, or this week as it is now, the clocks have gone forward. So data is at 12:30 rather than 1:30, and the market's open at 2:30 in the States. I said it's a pretty quiet week. We've got BP and Shell, see how they react to the extension of the windfall tax. Europe, not many large cap reporting their Inditex and Adidas for retail. Volkswagen, RWE for energy, and Vonovia is a German real estate company, so that might give us clues on the CRE problems in Europe. And in the States, Oracle, Adobe, and PDD are the largest stocks reporting. Data-wise, Japanese GDP shouldn't really worsen on a quiet Monday. So Japanese GDP has started off the week with there were preliminary figures before these. I think are the final figures. GDP year on year has actually come in surprisingly up on the quarter on quarter, slightly below forecast, but it was negative previously. CapEx, a little blip up, and that's probably what's driving it. External demand in line, price index, bang in line really. Private consumption, a tick lower. So net looks like CapEx, spending by large companies, the figures on countback have come in a bit higher than what we expected. So net, not as bad as it was when it was first reported a few weeks back. Tuesday, UK wages and unemployment data for the UK. Ignore all the CPI reads for Europe, because these are final reads for what we saw 10 days ago. Shouldn't really be any change. But the new data we've got is the US CPI on Tuesday afternoon, 12:30, pre the Cheltenham Festival. Hopefully we don't have to cry in our beer. It was, as I said earlier, it was last month's surprise. Again, is on the heavily weighted rental sector. Can we finally get some lower prints, which the market at large is telling us should be coming through? Just seems to be the way this index is constructed. Luckily, the Fed aren't watching it, but the market needs to equally become dismissive. Wednesday, not a lot. UK construction, industrial and manufacturing activity. Thursday, again, CPI releases in Europe, ignore them. PPI and retail sales in the States. So it was seasonally weak for retail sales. We want that to bounce back. We want the PPI to behave. And then finally, Friday, absolutely nothing out apart from New York Empire and Michigan inflation surveys, etc. So let's get down the pub and watch the Gold Cup. That's the way. Don't tell Alex, but that's where I'm going to be. Talking heads again, quiet. The Fed is probably on hold, I think, for the FOMC the following week. So we've got a few MPC and Bank of England people. Doesn't look like there's any major speeches of note. We'll keep a lookout for anything ad hoc. As ever, be careful out there with your trades, and the best of British to you on the week following British bye week. Good luck at Cheltenham. Come racing.